other companies in the sector to help them improve their performance. So I'm delighted to say that we have today with me Julian Winch, who's one of the mentors. Julian has got an excellent background in finance and has been in the finance sector over 35, 40 years. Mm-hmm. And so he's happy to share his knowledge and experience today in the session that he's going to be delivering, and that should be an excellent session. So thank you, Julian, for coming along and doing this. Just a few notes on technicalities first of all. I don't know how many people have been involved in webinars before, but just for those that haven't, in the bottom right hand corner you'll see a chat message box. This will enable you to type in questions when we come to the questions session. This session will last for something in the region of half an hour, and then there will be questions taken at the end. Can I ask that you save your questions till the end, please? And also, can you make them reasonably generic, so something that's not specific directly to your company that other people might not want to hear about? If you could just ask the questions that would be relevant to everyone who's participating, that would be great. If you do have anything that's specific to your company, then I'll be happy to discuss with Julian afterwards and get an answer to that question. So you could email me that question, and we will then make sure that you get the answer to it. So, as I say, we're now about to hand over to Julian. It's my pleasure to introduce him. I met Julian about 3 months ago when we did the mentoring training, and as I've said, he has an extensive knowledge of the financial sector. He's currently Director and General Manager of the Snap-on Finance division, which is part of the finance part of Snap-on Industries. So that's a global organisation. His wealth and knowledge of experience will serve very, very well in this seminar. So thank you very much. I'll introduce you over to Julian. Thank you.
Thank you, Malcolm, and good morning to everybody. As Malcolm said, I work for Snap-on. Some of you may have heard that, particularly if you're in engineering. And hopefully what I'm going to talk about today is fairly basic, but hopefully we'll be able to help you a little bit. If I may, just add that if you do have questions, feel free to put them into the chat box, as Malcolm explained, as we go along, but we will deal with them at the end. First of all, I'd like to just share with you the sort of areas I'm going to cover: planning and forecasting, cash flow and monitoring, and then credit management. Really the two, or the second and third one, do tie in together, of course. But I'm just going to start with a quote, and this is not rocket science, of course, but in 35 years of running an insolvency practice, there is only one thing that all failing businesses came to me for help for and had in common. None of them had any sort of written down plan. So in terms of planning and forecasting, really that is absolutely fundamental to running a good business. But bear in mind that, you know, whether you're Tesco or Barclays Bank, or whether you're a one-man band or a hairdresser, it doesn't really matter. The fundamentals are actually the same in the way that you run the business. Maybe the complication and complexity is a little different with a very large organisation, but the basic business fundamentals are pretty much the same for everybody. Okay, so let's start with planning and forecasting. I put a note on here to get professional help if you need it, because everybody has mixed experience and mixed knowledge about, you know, how to do planning and forecasting. Having said that, it isn't necessarily just something that an accountant can do. It probably does help, though, to use something like Excel, because Excel is ideally set up to be able to do numbers and totals and everything else that you would use Excel for. And in particular, you can project things across and copy and paste, etc. So Excel is probably a very good way of using a piece of software to to manage your accounting. but don't necessarily think that you have to be an accountant. I mean, certainly as in my position, I am not an accountant, so I'm not going to be talking to you about a lot of detail about accounts, because frankly, I'm not that experienced on it. But budgeting monthly income and your expenses at least a year out, that's pretty key. If you've got a plan for the year and you know where your business is going during that year, it certainly helps when looking at things like tax and the things that you have to report to HMRC, etc. So having it for 1 year as a minimum, I think is fairly important. And also try to continually roll everything forward 12 months, because doing that will give you some history as you move forward, and of course it will give you the projections going forward for the following year. So in terms of how you set up your spreadsheet, if that's what you use, try and make it so that you'll be putting in your projections first, and then as you move forward through the year, you can replace the projected figures with the actual figures. And it's a good idea to label it that way as well, because it just helps you understand what's going on. When you're looking at expenses, then fixed costs, things like your rent, other items where it's the same amount every month or every quarter, separate those from your what we call variable expenses, because the variable expenses are the ones that change month to month. You're going to end up with things that are seasonalized, for example. So making sure that you know your numbers and you are recording what the result was once that month's passed, very important. And I would suggest as well, drill down into the detail that suits you. Cover everything that you're going to be spending as a business, but just drill down and group it into sections that suits you. So for example, if you're employing staff, then you might have all your employee expenses in one group, and then you might want to separate the individual things out, say salaries from bonuses or overtime, that type of thing. But try to keep things in groups so that when you come to analyze it, you know where or where not your variances are. And again, as I said earlier, there are going to be things that are seasonal. For example, if you were in some kind of business that was connected to, say, landscaping, then you're probably going to have more expenses and more activity during the summer months than maybe you do during the winter months. So trying to keep things seasonal is a good thing to do. And also, when you're planning and when you're forecasting your numbers, give yourself some flexibility. That doesn't mean that you would budget something for, say, 10,000 when you're only going to spend 5,000, but putting a little bit of flexibility in there, a little bit of conservatism, I feel helps, because that way, if something does creep out of expectation, then you're not going to find that it has too big an impact on your overall results. One of the things, and this probably applies more to very small businesses, in my experience, people look at, or people have looked at, what do I need to break even? So I would never just aim to break even. Try and, to make your plan give you a decent growth. Having said that, if you were taking out, as a very small business, if you were taking out a fixed sum every month, for example, for your own use, then if that's satisfying all the financial requirements you have as an individual, separating yourself a little bit from the business, then actually break it even might be what you want. But make sure that, in other words, you've got some flex growing the business. And connected to that, account for your personal needs and those of the business separately. One of the things I've experienced over the years with some small businesses is what they call spending the turnover, and I will cover that a little bit later. But if you know that from your planning that the income that you're projecting and the expenses that you're projecting are going to give you the sort of return that you want, then take a fixed amount and maybe treat yourself as though you're an employee rather than that you own the business. It's a psychological thing in some respects, but by taking a fixed sum out of the business every week or every month, at least you'll know exactly where you are. One of the other things you need to do is to include taxation. Businesses that are turning over more than, I think it's 81,000, Malcolm, these days, will obviously be registered for VAT. Then there will be, if you're a small limited company, there will be corporation tax, and of course you have your own personal tax. But include that in your projections and planning and forecasting, because one of the things that I'm sure if I was speaking from HMRC, we will come across quite a lot of businesses who or people who can't pay their tax. So planning for that is pretty important too. One of the things that certainly the larger organisations do is to have a 3-year plan, and I've just shown here a generic planning cycle that you could pick up from the internet, and a quote here from Mr. Judd: "A good plan is like a roadmap. It shows the destination and usually the best way to get there." So it's about really knowing where you want to take the business. It's about understanding what's going on in the business, making sure that you are set up to achieve the desired outcomes. The strategies are right, the measurements and targets. That's why looking at your accounting and looking at how things are going to forecast is fundamental, really, to making sure that the business is successful. And then at the end of the day, of course, you get good results and you've achieved your goals. Okay, I'm just going to talk a little bit more about cash flow and management. This is quite a complex area, of course, because it does depend on what type of business it is and how complicated the setup is. But managing the income and expenditure at a minimum every month. Most businesses tend to work on a monthly cycle. It does depend a little bit on what business you're in, but a monthly cycle as a minimum is really what to do. So tracking each variable cost item against your budget, again, depending on how you set up your expenses. Fixed costs should always be on budget, of course. So if you're paying rent on your premises, or you're paying a fixed sum for a utility or something, then they will always be on budget. So you really, in some respects, probably don't need to pay too much attention to those, because they should be the same every month and they should just flow. But when you're looking at other costs, if something's moved out of what you've forecasted, so for example, let's say you were looking at your telephone costs, and roughly they're, I don't know, £1,000 a month, say. If one month you've suddenly gone to £1,500, then ask yourself a question, why is that? And understand why the cost was higher. It may, in fact, it's probably more likely to be that you've done a lot of extra business, so therefore it'll be balanced by additional income. But investigate it, understand why the expense is out. Don't panic about it. but just make some adjustments and where appropriate. And strong income actually doesn't necessarily solve all your problems. As I said earlier, that there will be examples of businesses who, if you like, spend the turnover. So when you're doing really well and you've had a really good month, it doesn't necessarily mean, great, I can go out and and buy something, or I can go and spend money on that item. Understanding when the right time is to spend money is about measuring against the overall forecast. And I would suggest that when you're planning something, if you were going to be buying some equipment, for example, for the business, then understanding when is the right time to buy that and budgeting for it, planning it accordingly. Extra income, though, as I said, having a very strong month is great for the business, but it doesn't necessarily solve all your problems, because you could have expenses coming down the line that are as a result of the extra income you've done. So don't necessarily concern yourself, but just be aware of everything that's running. And I would also suggest, and again, this will apply to very small businesses, don't take out more personal funds than you budgeted. As I said, when you have a very strong month, the temptation is to take some money out of the business. My recommendation would be not to do that until you're sure that that money's free and available. And bear in mind, of course, that there will be tax to pay on your profits at the end of the year. So invest wisely in your growth as well. Too fast or uncontrolled can be dangerous. You see many businesses, that, particularly ones that are just starting, that fly out of the traps. They're buying stock, or they're investing in the business without really necessarily understanding the effects that the cash flow will have on the business. So, for example, if you're the type of business that has stock, then of course managing fast-moving stock is quite easy, because it comes into your inventory and it goes out the door as a sale fairly quickly. Slow-moving stock, though, is something that is a little bit more difficult to manage. Look for deals with suppliers to see if you can avoid holding their stock. I mean, holding the stock that you're buying, because there is every opportunity to take items from them as you need them. These days, there are a lot of businesses that run much more efficient supply. For example, the just-in-time supply and that type of thing. So look for deals with suppliers if you're buying stock. And I would also say don't try and hold one of everything. Sometimes in servicing our customers, we feel like we should always have the items available. If you've got an item that is going to maybe sit on your shelf for 2 years, then that isn't very good financial management. So you may want to avoid doing that. Also tied in with cash flow, of course, is keeping an eye on your bank account. And my suggestion with bank accounts is, set up accounts or number of accounts that suit you and they suit your activities, and try and look for the best deal with the bank. Banks these days are a little more flexible in the way that they deal with their customers. And as an example, overdraft rates will always be the highest. So, if you're doing some investment into the business, you're buying some extra stock, or you're buying equipment, or whatever it is, then it may be better to actually get a loan from the bank, or even to get credit or finance from the supplier, rather than just paying by check and going into overdraft and then obviously paying all the the overdraft charges that go with it, because, as I say, rates of interest are probably higher on overdrafts than they are on anything else. Having said that, of course, just about every business requires an overdraft facility because of the fluctuations in cash flow. And I would also say, applying again to probably to the smaller business, try to set up a reserve account at the bank, or you may even want to put it into some kind of separate capital account that attracts some interest. But having a reserve to pay your tax means you don't have that anxiety when HMRC comes calling. And again, we mentioned VAT earlier. If you are VAT registered, it's a good idea to keep up to date. HMRC aren't the greatest people to have liabilities with. They're looking for their money. So, and also it helps the business as well if you're if you're keeping your VAT up to date. One of the other things I would also recommend is reconciling your bank statements. Account for all the cash that's coming in and all the expenses are going out. Make sure that that they all fit into your however you are managing and maintaining your forecast and your expenses, and also you be looking for unusual items. One of the things that people often miss is bank charges, as an example, because they generally appear on your bank statement, and sometimes you forget to move that into your into whatever, as I say, whatever system you're using for maintaining your expenses. And I would also say that, again, particularly for the very small businesses, sometimes time is money, but a half-day analysis a month, or if you want to use a weekend for it or whatever, but time spent analyzing what's going on in the business and understanding it is, in my book, is money well spent. Just going to move on to credit management. Again, it depends a little bit on what type of business you are, but of course we all have customers, and in order to make the business work, the customers need to pay us. So good credit management always starts at the point of sale. And this is an area, of course, which the business that I run, I have an awful lot of experience in. When I say that good credit management starts at the point of sale, what I mean is that understanding your customer, you don't have to know him intimately, because obviously, a lot of customers are going to be, well, they will all be new at some point, but it doesn't hurt to have a little bit of understanding of the customer. You may ask around if you're in a particular industry, or you might make some basic inquiries. You may get a company report from through the internet from Companies House, but just use your initiative. In other words, if a brand new person was to come and want a very big sale, whilst it's very tempting, you just sometimes have to ask yourself a few questions. Should I really be putting this at risk? And if you're in doubt, I would say don't sell. Or put it on some kind of cash on delivery if necessary. Again, it does depend on what type of business you're in and who your customers are, of course. But make sure that you both also have a clear understanding of when payment is due. The traditional thing of a 30-day invoice is perfectly, it's perfectly normal. But when you're negotiating, there's absolutely no harm in saying to your customer, I expect payment within 30 days. And it certainly isn't unreasonable to firmly state the terms either. At the end of the day, we're all running our business, so your customers are probably a business as well, and they will have the same thing with their customers. So it's not something that's unusual or anything to be, to be frightened of. And keep a reminder for yourself as well when you are expecting payment, because it may just be that all your invoices are 30 days and therefore, you know, it's a standard process. But sometimes you may have customers where, you know, because of the type of product or because of the type of business, or if you're having to make installations or other things, you may want to make it more than 30 days. But make sure that you're always aware of that particular customer and when payment is expected. If payment is late, my recommendation is always to act quickly. And in my experience, the telephone is probably the best medium for doing that. On a telephone call, first of all, you can judge your customer's reaction, which actually I feel is very important, particularly with a customer who you value. You don't want to be in a position where the way you wrote a letter or an email upsets your customer and you don't realize because he misunderstands. So a telephone conversation, I always think, is the best. However, sometimes you may need to confirm things in writing, because a telephone call, of course, unless you recorded it, is not much evidence of you know, of what was expected, if it ever came to a problem, particularly if you went to court or something. And make sure that you both know exactly when payment is due. As I said, when you have your telephone conversation, make a note of when the payment is expected. Make sure that the person at the other end, of course, understands the same thing. And don't be afraid to ask for your money. It's not unreasonable to say, please pay me. One of the other things we always do in our business, and I would also recommend, is document the discussion. So, in other words, you know, make a note of what you agreed,